So the big question is this: how do investors like us who trade options and manage our own money generate income regardless of where the stock market goes, and do it all in a way that lets us make time for the people and things we love, and yet still build wealth and remain profitable? That's the question, and this podcast will give you the answer. I'm your host, Kirk Duplessis, and you're listening to The Daily Call from Option Alpha. Hey everyone, this is Kirk here again from Option Alpha, and welcome back to The Daily Call. Today we're going to be talking about why you should not exercise your options early. So I recently got an email from somebody, and they wanted to know if it was a good idea to exercise their long call option early. They had bought a long call option ahead of earnings. The company had great earnings, and now the stock was really moving higher. And so they wanted to know, hey, look, should I exercise my long call option, take delivery of the stock? Because I made frankly, a guess and a lucky trade that the stock went the direction I thought it was going to move, and it made a big move. So now do I want the stock? The answer to this question is almost emphatically no, you do not want to exercise your option contracts early, because what you give up if you are a long option buyer during early exercise of your contract is you give up the extrinsic value that is still left in option contracts. So remember, option contracts are comprised of two different value components. You have intrinsic value, the value that you would get if you were to exercise immediately, which we understand intuitively. And then you have the extrinsic value of the contract, which is the time and volatility value that's still left. So in this case, this person was still more than 30 days from expiration, and a lot of the value in the contract was still tied up in extrinsic time value for the next 30 days. So should they exercise the contract early, they would basically be forfeiting that premium to the market. Instead, a better alternative would have just been simply to sell back the long call option, capture all of the intrinsic value as well as the extrinsic value of the contract. This is also why we don't see contracts that go in the money ahead of expiration get immediately assigned or exercised. A common thing that I see a lot with new traders when they start trading and they start selling spreads or iron butterflies or iron condors is that the stock may go in the money and breach one of their short call options or short put options. And immediately they think to themselves, well, now that it's breached my short call or my short put, I'm going to be assigned on these contracts. But it's not always the case. In fact, it's rarely the case. Because if they were to be assigned, then the long call option buyer on the other end would be forfeiting all of the extrinsic value in that contract. This is why we see most assignment happen the week of expiration and, more importantly, the last couple days of expiration, because at that point, most of the option contracts' extrinsic value has whittled away and is now down and near zero. So hopefully this helps out. As always, if you have any questions, let me know. And until next time, happy trading. Thanks for joining us on The Daily Call. Be sure to subscribe right now for more daily options trading ideas, strategies, and tactics to help you learn how to place smarter, more profitable trades. And if you like what we're doing, don't forget to give us a rating and a review so we can continue to bring you the best daily content possible. We'll see you again tomorrow, right here on The Daily Call from OptionAlpha.com.